Derivatives. Derivatives are the financial instruments which derives its value from underlying asset. Short selling. Short selling isn't speculating activity. It is done in case of bearish market. It is restricted in India. What is short selling? In short selling, first we will borrow the shares. Next, we will sell the shares at high price. Next, we will buy the shares at low price and return the shares. So these four activities involved in short selling. First, borrow shares. Second, sell at high price. Third, buy at low price. Fourth, return the shares. Next, settlement of derivatives. Derivatives are either settled in physical by way of physical delivery or by way of a net cash settlement. Participants of derivative contract. There are three types of participants in derivative contract: hedger, speculator, arbitrator. Hedger. The sole purpose of hedger is to avoid loss. Hedgers are risk averse. That means they do not like to take a risk. Next, speculators. Speculators, the sole purpose of speculator is to make profits. They are risk takers. Arbitrator. Arbitrator's sole purpose is to earn riskless profits. They earn profits based on price mismatches between two markets. Next, derivative derives its value from underlying asset. When market price goes to increase, that means prediction. If in the future, when the market price is going to increase, we will buy the call. When market price is going to decrease, this is the prediction of ours. If the market price is going to decrease in the future, buy put. If it is increase, buy call. If it is decrease, buy put. Derivative trader does not receive dividend. Theoretical price. What is meant by theoretical price? Theoretical price means should be price. That means the price that should be there for that share or a financial instrument. Next, theoretical fair value or intrinsic value of future or forward. How to calculate theoretical fair value or intrinsic value of the future or forward? This will be calculated as follows. Theoretical price means should be price. How to calculate theoretical value or fair value or intrinsic value of a future or forward? First, if underlying asset does not provide income, then in case of simple interest, in case of continuous compound interest, that means daily compounding and compounding interest. First case for calculating theoretical value or fair value or intrinsic value of forward or future. If underlying asset does not provide income, in case of simple interest, future value equals to spot value into 1 plus RT. Here, spot value means spot value of the underlying asset. R means interest rate per annum. T means time in years. Next, in case of continuous compounding interest, that is daily compounding, future value equals to spot value into e to the power RT. Here, spot value means spot value of underlying asset, and R means interest rate for compounding period. T means number of periods of compounding. E will be used in case of daily compounding, that is continuous compounding. Next, in case of compound interest, future value equals to spot value into 1 plus R whole to the power T. Spot value equals to spot value of the underlying asset. R means interest rate for compounding period. T, number of periods of compounding. This is the case if underlying asset does not provide income. What if underlying asset provides income, either interest or dividend? If underlying assets gives income, if income is in absolute terms, example dividend amount, dividend rate on face value, then in case of simple interest, continuous compounding interest, compound interest. In case of simple interest, future value equals to spot value into 1 plus RT minus dividend income. In case of continuous compounding interest, future value equals to spot value minus dividend divided by e to the power RT into e to the power RT, or spot value minus dividend into e to the power minus RT into e to the power RT. In case of compounding interest, future value equals to spot value minus dividend divided by 1 plus R whole to the power T into 1 plus R whole to the power T, or spot value minus dividend into 1 plus R whole to the power minus T into 1 plus R whole to the power T. So this is if income is given in absolute terms. If income is given in yield percentage, yield will be calculated on market price. Example, dividend yield is given. Then In case of simple interest, future value equals to spot value into 1 plus r minus y into t. Y is the dividend yield rate. In case of continuous compounding interest, future value equals to spot value into e to the power r minus y into t. Y is the dividend yield rate. In case of compounding interest, future value equals to spot value into 1 plus r minus y whole to the power t. This is if income is given in yield percentage. Yield will be calculated on market value. Dividend will be calculated on face value. So this is the case if there is income. If there is no income, the simple interest will be future value equals to spot value into 1 plus RT. If there is absolute amount of income, future value equals to spot value into 1 plus RT minus dividend income. If it is in percentage, future value equals to spot value into 1 plus R minus Y into T. In case of continuous compounding, if there is no income, future value equals to spot value into e to the power RT. If there is absolute income, future value equals to spot value minus dividend divided by e to the power RT into e to the power RT. If there is percentage of income, future value equals to spot value into e to the power R minus Y into T. Next, in case of compounding interest, if there is no income, future value equals to spot value into 1 plus R whole to the power T. In case of absolute income, future value equals to spot value minus dividend divided by 1 plus R whole to the power T into 1 plus R whole to the power T. In case of a percentage of income, future value equals to spot value into 1 plus R minus Y whole to the power T, where Y is the dividend yield rate. Which type of calculation is to be done, whether simple interest, compound interest, or continuous compound interest? If in the question it is specifically mentioned, follow the question, otherwise do simple interest. Next hint is, if E value is given in the question, do continuous compounding. If monthly interest rate is given or interest on monthly rest is given, do monthly compounding interest. That is normal compounding should be done. Next, arbitrage process using future contract or forward contract. In case of arbitrage, there will be zero investment. In case of arbitrage, compare given future price and theoretical future price. Theoretical future price means should be price. If given future price is greater than theoretical future price, the shares are overvalued. Arbitrager should sell the future. That means short the position. So arbitrager should follow following process. At zero time, that means current time, or at spot, borrow money and buy shares. At maturity of the future contract, sell the future and repay money borrowed with interest, and dividend will be received if it is given in the question. If given future price is less than theoretical future price, that means shares are undervalued, arbitrager should buy the future, that means long position. So arbitrager should follow the following process. At zero time, that means at spot, sell the shares and invest money. At maturity of the future contract, withdraw the money invested with interest and buy future. Next, hedging using forward contract or future contract. Hedging is done to reduce the risk. Hedging using stock futures. In case of hedging using stock futures, take opposite action in the future stock futures. If you have long position in the stock, short in the future. If you have short position in the stock, long in the future. Next, hedging using index future. Index means a market. Hedging using index future. In such a case, we need to calculate number of future contracts to be traded. That is hedge ratio equals to value of shares or portfolio divided by price of future contract into beta of share or portfolio minus required beta. Required beta, if question is silent, generally assumed to be 0. Beta means risk of securities when compared with the market. So first we will calculate number of future contracts to be traded, hedge ratio, that equals to value of share or portfolio divided by price of the future contract into beta of share or portfolio minus required beta. If question is silent, required beta is 0. Price of future contract. How to calculate price of future contract? Denominator price of future contract equals to future price into lot size. If quoted price of the future is given in the question, then use as it is, otherwise calculate a theoretical price of the future. This number of contracts to be traded will be rounded off to upper side if answer is in decimals. Required beta will be considered as 0 if question is silent. So required beta will be considered as 0 if question is silent. Next, how to calculate number of future contracts to be traded n by using other formula. Risk number of futures contracts or number of future contracts to be traded n equals to risk to be covered into beta 0 minus beta n divided by contract value. Here contract value equals to future value into lot size. Beta 0 is the risk at present. Beta n is the risk willing to take by the investor or arbitrator or hedger. By the hedger. Next, if share or portfolio has positive beta, if you have long position in the stock, short in the index future. If you have short position in the stock, long in the index future. In case of negative beta, in case share or portfolio has a negative beta, if you have long position in the stock, long in index future. If you have short position in the stock, short in index future. The important point is cash or bank balance in portfolio will not be hedged. Beta of cash or bank balance equals to 0. Beta of share or portfolio equals to percentage of change in value of share or portfolio divided by percentage of change in value of market gives beta of share or portfolio. Hedge ratio means beta. Here hedge ratio means beta. Next, hedging a portfolio by disposing of securities from existing portfolio and acquiring risk-free securities in place of them. Proportion of securities to be disposed of or risk-free securities to be acquired, that is required beta equals to beta of risk-free securities into weight of risk-free securities plus existing beta portfolio into 1 minus weight of risk-free securities. Beta of risk-free securities will be 0. Next, calculation of hedge ratio. If spot price and standard deviation, future price standard deviation, calculation of hedge ratio. If spot price standard deviation and future price standard deviation is given, hedge ratio equals to sigma x divided by sigma f into RSF, where sigma s is the standard deviation of the change in spot price, sigma f standard deviation of change in future price, RSF correlation coefficient between spot price and future price. This calculation of hedge ratio, if spot price standard deviation and future price standard deviation is given, is used in case of commodity derivatives. Hedge ratio equals to sigma x divided by sigma f into RSF. Sigma x is the standard deviation of the spot price. Sigma f is the standard deviation of future price. RSF is the correlation coefficient of spot price and future price. Next, types of margins in future contract. Future contracts are generally daily settled. So, following are the margins. First, initial margin. Initial margin is the security deposit. How to calculate initial margin? Mu plus 3 sigma is the initial margin, where mu is the daily absolute change. Sigma is the standard deviation in daily absolute change. Next, mark to market margin. It is the daily settlement on closing price. It daily changes with the daily changes will be adjusted against the deposited initial margin amount. Here daily changes will be adjusted against first initial margin amount, so that they will be marked to market on regular basis, that is daily basis. Next, maintenance margin. It is the lower limit as fixed by the stock exchange. Maintenance margin will be fixed by stock exchange. So there are 3 types of margins: initial margin, mark to market margin, maintenance margin. Next, participant can deposit amount in call money account. Next, if the balance in initial margin account after adjusting mark to market margin goes below lower limit as fixed by the stock exchange, margin account balance will be restored to the original amount of the initial margin. The participant shall deposit amount in the call money account to restore the balance. Format for solving practical problems. Day, first column is day. Second, change in closing future value, that is mark to market margin. Next, margin account. Next, call money. Call money is the 4th column. Next concept, forward contract. Forward contract is over-the-counter market contract. Here, contract to buy or sell an underlying asset will be made at predetermined price and predetermined quantity. Here, buyer has the obligation to buy and seller has the obligation to sell. Forward contract. It is the over-the-counter market contract, over-the-counter contract. It is customized. Here, there is no requirement for margin, but there is a default risk here because there is no supervisory authority. Here, settlement will be done on maturity. Future contract. Future contract is exchange traded because it will be done through stock exchange. It will be standardized. Margin is required. Here, there will not be any default risk because stock exchange is there to supervise the process. The settlement will be done on daily basis. Mark to market adjustment will be done to the margin. Liquidity. Liquidity is low in case of forward contract. Liquidity is high in case of futures contract. Regulations are low in case of forward contract. Regulations are high in case of future contract. Generally, forward contracts are used by hedgers and future contracts are used by speculators. Next, parties in future contract. There will be future buyer and future seller. Future buyer, contract to buy. Future seller does contract to sell. The betting will be upside for future buyer and downside for future seller. Position long for future buyer, F plus, and position will be short for future seller, F minus. Next, stock index future. Stock index future means a future contract on stock index. Examples, Sensex, Nifty. It can be on overall market or on sector wise also. The settlement will be only in cash, that is net settlement. And delivery, there is no physical delivery here. Stock index future is more liquid than stock future. It is difficult to manipulate. Margins, initial margin, maintenance margin, variation margin. Variation margin means mark to market margin. Initial margin required to be deposited when trader enters into future contract. Maintenance margin means minimum balance to margin. If actual margin is less than maintenance margin, trader has to bring back margin amount equal to initial margin. Variation margin means amount of margin brought by the trader. If margin amount is less than maintenance margin, then variation margin comes into picture. Margin amount can be withdrawn if actual margin is greater than initial margin. If question is silent, assume no withdrawals. If future contract is squared off, margin amount is refunded on the date. Initial margin. How to calculate initial margin? Mu plus 3 sigma. Mu is the average daily absolute change in the future contract. Valuation of futures. Cost to carry model or TMP model. Theoretical market price model. Future price or forward price equals to spot price plus interest or dividend saved minus dividend foregone, or F equals to S into 1 plus R minus D, or F equals to S into e to the power R minus D into T, or F equals to S into S minus F equals to S minus present value of dividend into 1 plus R. Next concept, beta management. Beta, a relationship between a return of stock and return of market portfolio. Beta equals to change in value of the stock divided by change in value of market portfolio. Beta is directly proportional to risk. How to calculate number of contracts to be bought or sold equals to VP into beta of T minus beta of P whole divided by FMBF. VP means value of portfolio, BT means target beta. If not given, assume 0. Beta P, beta of portfolio. F, future price of stock index. M, multiplier or lot size. Beta F, that is beta of future. Cost to carry model, commodity future. Theoretical future price of the commodity equals to F equals to S plus present value of storage cost minus present value of convenience yield into 1 plus R. F is the theoretical future price. Present value of storage cost minus present value of convenience yield, or risk-free rate of return, as spot price. Hedge ratio. Sigma of spot price divided by sigma of future price into correlation of spot and future price. Position amount equals to exposure into hedge ratio. Next concept, options. Expected value of option equals to summation of intrinsic value into probability. That means first we will do intrinsic value into probability for all cases, and total summation will give the expected value of option. Options are of two types, call option, put option. Call option, right to buy, that means long position, expectation of price increase. If you expect that in the future price will increase, buy call option. If you expect that price will decrease in the future, buy put option. Put option means right to sell, that means short. How to calculate break-even point? Break-even point in case of call option is excess price plus premium. Break-even point in case of put option is excess price minus premium. Next, on the basis of cash flows, options are of two types: European option, American option. European options can be exercised only on maturity. American options can be exercised on or before maturity. Therefore, premium amount on American option is greater than European option. Premium is divided into two types. Premium consists of intrinsic value and time value. Intrinsic value, this premium and intrinsic value can never be negative, but time value can be negative or positive. So premium will be divided into two categories: intrinsic value, time value. Premium and intrinsic value can never be negative. Time value can be negative or positive. Next concept, option pricing or valuation of option. There are three models to calculate value of option: binomial model, put call parity theory, Black-Scholes model. Binomial model is again divided into three categories. First one, risk neutral probability approach, delta hedging or risk-free portfolio approach, replicating portfolio approach. First one, risk neutral probability approach. As per binomial model, as per this model, it assumes that there will be no risk. Only two possible prices of stock on maturity exist: SU, upper price of the stock; SD, lower price of the stock. Here, value of option equals to expected payoff discounted with RF rate. RF means risk-free rate of return. Next, how to calculate value of option? In case of call option, value of option is CU into P plus CD into 1 minus P whole divided by R. Here R means general case 1 plus R. How to calculate U? U equals to SU by S0. That means upper price divided by current price, spot price. D equals to SD by S0. SD means lower price divided by current spot price. How to calculate P? P equals to R minus D divided by U minus D. Here R equals to 1 plus R in normal case. Therefore, value of option equals to, in case of call option, CU into P plus CD into 1 minus P divided by R. R means 1 plus R. In the question, if the question specifies that compounding is done annually or effectively, use power. In case compounding is done, continuous compounding is done, 1 plus R will not be used, e to the power RT will be used. In such a case, probability will be R minus D divided by U minus D. Here R means e to the power RT. And finally, value of call option equals to CU into P plus CD into 1 minus P divided by R. Here R means e to the power RT in case of continuous compounding. So another important point is, in case if in the question compounding annually or compounding effectively is given, use power. Next, value of put option P0 equals to PU into P plus PD into 1 minus P divided by R. R, 1 plus R will be considered in normal case. In case of continuous compounding, e to the power RT will be considered. In case compounding annually or effectively is given, use power. P equals to R minus D divided by U minus D. U equals to SU divided by S0. D equals to SD divided by S0. Next concept, multi-period or two-period binomial model. Here, option periods are divided into two periods. We do backward calculation in these problems. We calculate value of option for each node by backwards. In American option, value of option will be present value of gross payoff or intrinsic value of the option, whichever is higher. In case of American option only, value of option will be calculated as present value of gross payoff or intrinsic value of the option, whichever is higher. So in case of multi-period or two-period binomial model, we do backward calculation. In this problem, backward calculation is done. So first we will consider node A, node B, node C. First we will do calculation for node C, node B and node A. Finally, we will get the answer of value of option. In case of European option, it will be different. In case of American option, it will be different. Next concept, delta hedging. Delta of call equals to Cu minus Cd divided by Su minus Sd. Delta of call equals to Cu minus Cd divided by Su minus Sd. Next concept, option Greeks. Option Greeks are used to calculate sensitivity. Price of option depends upon following factors. First one, stock price S0, excess price E, time T, volatility sigma, rate of interest R. Stock price may change, excess price is constant, time, volatility and rate of interest may change. Due to change of this factor, option prices changes. So we carry out a sensitivity analysis, that is a rate of change in option price with respect to each factor, keeping other factors constant. So there are five option Greeks: delta, gamma, rho, theta, vega. First, delta. Delta equals to change in V0 divided by change in S0. Gamma, change in delta divided by change in S0. Next, rho, change in V0 divided by change in R. Theta, change in V0 divided by change in T. T means time. Vega, change in V0 divided by change in sigma. So for 4 cases, the numerator will be change in V0 only. Delta, rho, theta, vega, numerator will be change in V0. And denominator will changes. For delta and gamma, denominator is same. For rho, it is R. For theta, it is time. For vega, it is sigma. Next concept, Black-Scholes model, BSM. As per BSM, value of call option equals to C0 equals to S0 into ND1 minus E or K divided by e to the power RT into ND2. In case of Black-Scholes model, it is assumed that there will be continuous compounding. So e to the power RT will be used. What is S0? C0 means call option. S0 means spot price. ND1 means delta of option or hedge ratio or probability of spot price greater than excess price E or K. ND2 means probability of excess of option. S0 means current market price. E means excess price. R means risk-free rate of return. T means time. N means normal distribution. So C0 equals to S0 into ND1 minus E or K divided by e to the power RT into ND2. How to calculate D1? D1 equals to natural log of S0 divided by ERK plus R plus sigma square divided by 2 into T whole divided by sigma square root T, where D2 equals to D1 minus sigma square root T. ln means natural log. Normal distribution table, Z table. Normal distribution table is also called as Z table. Mu means mean. Mean in case of a normal distribution table. Mu equals to average growth, that equals to R minus, how to calculate mean? R minus sigma square divided by 2 into T. Z, how to calculate Z? Z value, Z equals to x minus mu divided by sigma or x minus x bar divided by sigma. So this is Black-Scholes model. C0 equals to S0 into ND1 minus ERK divided by e to the power RT into ND2, where D1 equals to natural log of S0 divided by E plus R plus sigma square divided by 2 into T whole divided by sigma square root T. D2 equals to D1 minus sigma square root T. Next, how to calculate value of put option. Value of put option using put call parity theory. Value of put option using put call parity theory. S0 plus P0 equals to C0 plus ERK divided by e to the power RT. Using BSM, P0 equals to KRE divided by e to the power RT into N minus D2 minus S0 into N minus D1. N minus D2 means 1 minus ND2. n minus d1 equals to 1 minus n d1. How to calculate d1? Natural log of s0 divided by e plus r plus sigma square divided by 2 into t whole divided by sigma square root t dt equals to d1 minus sigma square root t. How to calculate standard deviation for t days? Standard deviation for t days equals to standard deviation for 1 day into square root t. How to calculate, for example, how to calculate standard deviation of an year? Standard deviation of an year equals to standard deviation for month into square root 12 gives standard deviation for a year.